Well, let's get started. We've got a phenomenal discussion with a wonderful dear friend, Miss Ruth Benjamin. And Ruth, for the past 30 years, has been doing 1031 exchanges. Now, that's not a 1035 like all of us insurance people do. It's 1031, so real estate. But then for the last 10 years, she's been working in the field of everything that didn't fit within 1031, right? So you sold real estate and you don't want a big taxable event. What do you do now? And then a bunch of other topics and strategies, tax strategies that really have nothing to do with real estate necessarily, but just reducing, like heavily reducing or eliminating taxes. And I'll start before I give Ruth the floor. A dear friend of mine reached out to me 2 months ago now and said he was selling his company for multiple tens of millions of dollars. And it was like Thursday, right? And he's closing on Tuesday, right? And I think it was even Thursday afternoon. And we start this discussion and I was like, I've heard that there's a way that you can eliminate having to pay taxes when you sell your business. And let me see if I can and his wife happens to be a CPA. And we got Ruth on the phone, and within a matter of minutes, she had explained how it works, how they could not pay taxes for over 30 years. And, he sold a business for, north of $20 million and has no taxable event for 30 years because our tax ninja, Ruth Benjamin. So, Ruth, thank you for being here today. And Catherine, I'm so glad you're with us. And we're just going to have a discussion with Ruth and find out about all the magic she can do with telling Uncle Sam that we've got another favorite relative that we like more than him.
Exactly. All right. Thank you, Eric. And thank you, Catherine, for having me here today. I am going to share my screen and we can get started.
Perfect.
So first of all, I want to start off with letting everybody know that this is one of the strategies that we have that can help eliminate taxes and defer some taxes. This one's kind of like a combination of the both. But this one is understanding the doing well by doing good legacy preservation system. What I'm going to talk to you about today is what everybody needs: asset protection. The last thing you want to do is grow your wealth and then have somebody take it away from you. So this is better than LLCs when you're owning real estate. This is the tool for every business owner, especially, restaurants. There's a lot of lawsuits out there with restaurants. There was one that a lady slipped and fell on a spilt soda and she broke, I forget what she broke of her body parts. And she sued and got several hundreds of thousands of dollars from the restaurant. Well, little did anybody know, this lady 2 minutes before she slipped and fell had gotten a fight with her boyfriend through the soda. And that's how the soda got on the floor. So, I have a whole book here of frivolous lawsuits. And that is why everybody needs asset protection. But the beautiful thing about this product also is it helps with tax mitigation. So we all want to lower our tax bill. Can you legally take your tax bill to zero? You absolutely can if you choose to. We don't always recommend you take it to zero, but it is possible and it is legal. So we're talking today about a family holdings trust. It's a non-grantor trust, and I'm going to walk you through it, but we pair it with a private family foundation. So the family holdings trust holds all your assets, keeps you protected from any lawsuit, and I'll go through it. And the private family foundation is the part that gets rid of the tax bill. So don't get us confused with a lot of trust peddlers on the internet that talk about these trusts that all you have to do is have the trust and you can defer your tax bill in perpetuity. That is false. You have to have the trust for asset protection, and then you need the private family foundation to help with the tax bill. So again, I'm Ruth Benjamin.
Hey, Ruth.
Uh-huh.
Sorry, on that. So back on, can you go back on that slide real quick?
Yes.
That that concept looks really familiar. And is it me, or I mean it 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 makes me think of a former president who started a foundation. Is that, I mean, this is like what like the billionaires are doing in order to
Exactly.
reduce or
Yes.
eliminate taxes. Um,
Yeah. Yes.
but you know, you hear about these foundations that they
How about the
start, and then their
Gates?
kids are running it. Yeah,
The Gates have the
yeah,
foundation. Zuckerberg has the charitable holdings, which is a different strategy. But yes, this is what the billionaires are doing.
yeah. And then you're about to get into it, and so I'm not going to steal your thunder, but I would like you to address as you go into the next slide of who you are and why we should care, and what makes you the authority is about your dealings with the IRS, and uh,
Absolutely.
how that separates you from most people that are out peddling trust, because there's a lot of people peddling trust, and there's a reason that we have not got into that game for 25 years, even though I've been approached countless times by a lot of people that I love, and I'm like, man, that's great. It's not for us, right? So this is literally the first time that we've ever brought anybody before our group to talk about it, because I know that you're the real deal. And a little tongue in cheek. And I know we can trust you, right? I was
I
about to
will
say that, and then I
not.
was like, I just used the word trust. I was like, wow, that's so cheesy. But it is true, right? So that's
Mhm.
why I was excited to bring you on today, because we've seen not this exact, but selling trust and doing things like that, and practicing
Yeah.
law without a license is something a lot of people are. Some people aren't afraid of. Some of them are. But then so how do you do this right? And then what makes you the authority? And with that said, head on to your
Yeah.
next slide and tell us.
So that's a good point. You cannot practice law without a license. We have attorneys that back us up. I'm in the front here, right? I'm telling everybody about it, but I'm not the one that's going to give you the trust. The attorneys are going to give you the trust. And I've been in the trust world for about 5 years, and I was familiar with the trust peddler strategy. They call it IRS Code Section 643. I bought that trust 643. And how did I find out it didn't work? My CPA told me I'm not filing a tax return on that. That doesn't work. So because of the field I'm in, and I've been doing these strategies for many, many years, I have very close relationships with the companies that do these and other tax attorneys and CPAs. So I do a lot of due diligence on products and make sure that they're going to be a good fit. So my bad trust have been decanted to this new trust. So it's the old ones are no longer valid. They have been moved to this trust that I'm going to talk to you about today. But there are hundreds of thousands of people selling trust. There are hundreds of thousands of types of trusts. So you have to make sure that you're working with the right product. And we are very happy to send the information to your tax advisor so they can see that it's something that works for you. So again, I'm Ruth Benjamin. I call myself a capital gains tax strategist. I spent 22 years of my 1031 career as president of two different title company owned accommodator companies. I'm currently the customer success manager of National 1031 Exchange Services, and it's now 10 years as a capital gains strategist working on multiple strategies. So this is my family. The man standing next to me is John that we've been talking about. He's my husband and very supportive in our business here. And these combination of girls, 4 of them I birthed, 3 of them he did. And so when we got together, we ended up with 7 daughters, all above 30 now. So none of them are actually living with us, but we do have 7 daughters of relationship problems that come about with it. But with these 7 daughters, this trust that I'm showing you today is the best prenup you can get. So a few of my daughters own houses before they're married. So if you use this trust and you and your husband enjoy living in it, but if for some reason that relationship does not stick, the husband, when he walks away, has to walk away without any real estate, or at least the ones my daughters owned and put in the trust, because the trust owns it. They don't. So this trust will protect against divorce, which of course we don't encourage. But if it happens, you don't want to lose your assets with that happening. And it's it's the best thing out there. So be cautious, especially if you have children getting into marriages. We know that a lot of the times, unfortunately, they don't value the same things as us older people do. So you just never know what's going to happen with that. So that is another reason to have these trusts. So we're not providing you or attempting to provide you tax or legal advice by making this overview available to you, nor does the overview itself contain sufficient information to constitute tax or legal advice. So this is the best way to say it. Nelson Rockefeller says it the best: the secret to success is to own nothing but control everything. So the types of things that this trust helps with is capital gains taxes. And I'm going to show you at the end how to defer most of the tax, 30 or 40 years, and eliminate a portion of the tax when you use this trust. This helps with 1031 exchange stressors. So those of you that aren't aware of 1031, that is for investment real estate owners. If you do a 1031 exchange and you're selling a piece of investment property, not a primary residence, not a business, this works for investment real estate. If you meet the prescribed criteria by the IRS, which means once you sell a piece of property, you have 45 days to identify a new property. You can identify up to 3 within the rules. That's the easiest part. You can identify more, but there's other rules. And as long as you buy one of those properties by the 180th day from the day you sold, you can defer your taxes until you die. If you ever sell that property while you're alive, you're going to go back and pay all the taxes. But 1031 exchange is a great tool. It's probably the best cost tool out there. And I am a 1031 accommodator and can help with that. But this is when 1031, a lot of people call me and they say, I'm tired of owning real estate. The last tenant I put in, they damaged my property. I had to go in and fix it. I just don't want to do this anymore. So that's why I have these other strategies that help those clients. Plus,
so on a 1031, you can't just 1031 from property to property to property.
You can, but every time you do it, you have to identify properties by the 45th day from the day you closed, and you have to make sure and buy one of those you identified. So in a fast moving market, it's hard to buy the ones you identified because they're moving so fast. So
yeah,
we've
definitely learned that, where it's like we offered more than what the house cost and it still went to somebody else. And you're like, yeah, I could see how that could be a problem.
It becomes a big problem. So it really depends
Now,
on the market that you're in.
You mentioned that there was like a certain percentage or something like that of 1031s that failed because of the deadlines that you have involved. Wasn't it like 60, a higher number or something?
60% fail.
Oh my goodness. Yeah.
In a fast market.
Taxes,
yeah, in a fast market, you now let me give you an example. I had one business owner that went to auction to buy the piece of land next to him because he wanted to expand his business. So in the 1031, he identified it, he went to auction, and he lost the auction. Now he did have other properties identified, but he really wanted that land because it was adjacent to his business. He needed that land.
Yeah.
So he ended up going to the buyer who won the auction and offered him $180,000 more to sell it to him. So just because somebody else bought it doesn't mean you can't buy it from them, but you gotta have to pay a lot more.
Yeah. So 60% of the 1031. Now, because in my world we're doing 1035 rather than 1031, and they really work every time, right? You just tell one
Yeah,
carrier to send it
because
to
you're
another,
rolling,
and
right?
yeah. So we're just rolling. But on a 1031, you have to acknowledge it within 45 days, and then you've got, what did you say, 100 and
Take title. So after the 45
yeah,
days, you have 135 days more to actually take title to it.
okay.
So
But yeah,
what's
so
been
60% of the time it fails though. What's that,
right
Ron Burgundy?
in the
60% of the
fast
time it
market?
works every time.
Yeah, so it is tough for people because a lot of times once you get to the inspection period and it's after the 45th day and you find out maybe there's a lot of termite damage or the foundation is sinking, and the seller says, I'm not fixing it, and you're like, I'm not buying it, but you're past your 45th day and you can't identify something else. So that's
Yeah.
where 1031 creates a problem. But we're not talking
Mhm.
about that solution today,
Right.
but we have tax deferred cash out. So if your 1031 is failing, you can move over to the other strategy, defer your tax bill for 30 years and get your cash within 5 days. So
But
that's
wait, there's
another
more. Call
strategy.
now.
Yeah. So that's one, and we'll talk about that one on another webinar. But
Yeah.
so now you're out making investments, right? You want to make the best investments possible. So you make all this money on this investment. Then what happens? The tax bill comes. So it reduces your return on the investments. Problem number 4, future tax hikes. We always search the Tax Foundation website for updates on proposed tax laws. So the IRS is trying to raise the capital gains tax from the current tax bracket today of 20% on the high end. It's 15 or 20, but they're trying to raise it to 28%. Now, over the last 30 years with me doing 1031 exchanges, it was at 28% before, okay? It goes up and down. Over the last 30 years, it's gone up 4 times and down 3. So they're talking about taking it back up again. And then anybody that has gains over $1 million, they're talking about increasing the tax rate to 39.6%. So that's anything over $1 million. So that really hurts people. They're talking about eliminating step up in basis. Step up in basis is when you buy a piece of property, let's say for 500,000, and you pass away. And so when your children, you bought it for 500,000, but today it's worth $1 million. Okay, so you have a gain of 500,000, and you died today, and your children receive the property at the step up in basis. They're going to get it at the value of $1 million, so they don't have to pay the tax bill from the 500,000 when you bought it to the $1 million. So they're talking about eliminating that. They haven't done any of this yet, but it's out there for them to try to get more taxes, right? So they can take care of this deficit. So I see a lot of things passing just for that reason. So they also are talking about, with the 1031 exchange, of capping the amount of taxes that a person can defer, which is 500,000 per person per year. And they're also talking about reducing the estate tax exemption from 11.58 million to 3.5. So like I said, all this is in the works. None of that has happened, but we do know for facts that in 2026, with the sunset clause, it's expected to drop that estate from the 11.58 to 6 for sure, but they're trying to get it down to 3.5. Problem number 5 is not having solid asset protection. I told you about the lady slipping on the soda. You're a restaurant owner, you have to pay. We have a client currently that rented out one of his rental properties to a person, and that person took it upon himself to sublease that property to a disabled person. That house was not set up for a disabled person, and the disabled person sued the owner. He is currently in a lawsuit. He's scrambling to make sure all of his trust stuff is set up and ready to go so he can avoid that lawsuit. So don't wait for last minute. I also had somebody call me panicked. that he was in years ago, he was in one of those penny auctions, MLMs. Well, they declared it a Ponzi scheme, and that was 11 years ago, and they are coming after him for a judgment now. So he was scrambling to get this trust set up to protect him so they wouldn't take his house. They wanted to take 700,000 from him. His house is worth 300,000. He
Wow.
you know, he he's at the end of his life working, right? Remember what I said, don't build all your wealth to have somebody come and take it from you down the road, especially at my age. I have a few years till retirement, which I'm never going to retire probably, but you don't want this to happen to you. Okay? So that's
Well, and Ruth,
solid asset
you know,
protection.
yeah, and that's a huge deal. Like we talk about it, so with life insurance and annuities, you've got some protection from creditors, and in some states like Texas and Florida, you've got complete protection. But the thing we always tell people is, you can't buy insurance when you need it, right? When your house is on fire, it's too late to get the insurance. You can't get a loan when you need it. You have to prove to the bank that you don't need their money. And when it comes to, the trust and these, like if you're already in trouble, it's too late. You have to have already
Yeah,
set it up and bought it. If you're buying it after the fact, even in annuities that are fully protected from creditors, if you buy it after the fact, that judge can unravel it because they're saying that you did that. It was deemed to
fraudulent
effectively be
conveyance.
fraud. Right.
Fraudulent
It's fraud.
conveyance,
So,
absolutely.
but if you buy it beforehand, I always talk about, well, one of my favorite stories is for years I'd always talk about, I talked about creditor protection, and I talked about how O.J. Simpson owned a bunch of annuities, and I'm bankrupt and all that, but he had, like $8 million in annuities that he's getting a lifetime income on, right? And nobody can touch that. But also Kenneth Lay of Enron, owned a bunch of annuities, and he said he's bankrupt. And I always told that story everywhere I go. And one day I'm telling that story to a group of advisors, and they all start laughing. And I'm like, did I say something funny? And they look at one guy, and I'm like, what? And he's like, he's the one who sold all those to Kenneth Lake. But the fact is, if you buy them in advance, you truly, even if you're a dirtbag, that Kenneth Lay, everybody knows that name because of Enron and what they did and the impact it had on the economy. Everybody knows about O.J. Simpson, but the fact is, even those guys were protected because they set it up in advance, right? So buying a trust or buying, an insurance product for creditor protection, it's kind of like the Chinese proverb, what's the best day to plant a tree? 20 years ago, and if not today, right? Because if you wait
Right.
until after you got a problem, it's too late. So that said, I will get off my soapbox, and you're welcome to
Well,
continue with
I'm
the
glad you
problems.
said I'm glad you said that because this trust protects you from bankruptcy also. Okay, so if you're a business owner, we all know how businesses go. We can have some great years and we can have some bad years. So if you have all your assets in a trust, not 6 months before you file bankruptcy, but don't a year, to get it in advance and something happens and you have to file bankruptcy, you won't lose your assets because the trust owns them and that's not a part of your bankruptcy. Problem number 6, corporations, S corps and LLCs don't protect you as well as you think. We are all taught when we buy real estate and we set up businesses that we want to set them up in an entity. Well, it's easy to pierce the corporate veil if you're getting sued because they're saying the judge, the attorneys that are fighting for the person who's suing you is saying that's your alter ego. That's you. You are the LLC. You are the corporation. So if you don't have 35 members or more in your LLC or your corporation, you're not getting the protection that you think that you're getting. And the judge can pierce the LLC or the corporation and let that person who's suing you get to everything that you own. So again, roughly 50% of entities are getting pierced because they're not operating their business properly when it comes to the records, the meetings, and the minutes. If those records were pulled into court. So it's an easy way to pierce the corporate veil. So once you have your trust set up, It can be done away with, all the LLCs and corporations, if you want to. You don't have to, but no more meetings, corporate minutes, if it's determined that your corporation is not needed. So the states are piercing these cases, 39.34%. Federal courts are piercing these LLCs and corporations, 41.42%. So not the best way to hold properties. Problem number 7, insurance is a partial solution, not the solution. So a lot of people buy umbrella policies and that, but umbrella insurance policies often do not cover punitive damages or gross negligence. We encourage you to keep your umbrella policies. This is not about canceling anything, because if someone does sue you and the insurance policy covers you, then you're in great shape. The person who sued you got something, but they're not going to touch what you actually have in your trust. Okay. And let me say this, I'm not sure if it's coming up later in the presentation, but if you got sued and somebody won, okay, they got a judgment against you, a charging order. The trust document is a contract, and that contract is between the trust protector and the grantor of the trust who set it up. And what that our documents say is, if you are not a beneficiary of this trust, you are not allowed to any money. So if somebody wins a lawsuit, they're not a beneficiary of the trust. So the trustee tells them, sorry, I cannot give you any money out of this trust. And one of our clients was the person who wrote these trusts is my business partner. We didn't buy a license to do this. He's my business partner. And he had to represent his brother, who got into, he was trading for people and didn't realize, he was an architect and didn't realize he wasn't supposed to be doing this. So the state of Maryland got $100,000 lawsuit against him almost 30 years ago. The state of Maryland has taken him to court 3 times and has lost all 3 times, and they still have not been able to pierce his trust. He now owns 53 doors, 3 businesses, and he's been living the last 30 years without paying that 100,000 judgment. Now, I'm sure the 100,000 judgment has a lot of interest on it now, right? But he doesn't worry about it because he's protected. So this is what we want you to do, is encourage you to live your life now out of this trust. So problem number 8, filial responsibility statutes. Many states
Hey, Ruth,
have...
real quick.
Mm-hmm.
If anybody has questions as we're going through this, can you please type them in the chat or the Q&A section, and just let us know any questions, because we're gonna address questions at the end. But as you've seen this, I want you to ask questions, right? I know this is a webinar, so you're muted, but type in your questions, because we do want to address them. And I didn't want to wait till the end, and I just thought I should have mentioned at the beginning, because we're now on problem number 8. But again, as you have them, type in your questions. We're going to address them. We're just going to keep going. So that said, please keep going.
All right. Many states have filial responsibility statutes allowing long-term care facilities to seize the assets of adult children to cover unpaid bills of their parents. Okay. So be cautious if you have a parent that, you know is struggling to pay that long-term care bill, which you shouldn't if you have insurance, but we know how that goes, that you don't want to end up paying that bill for your parents. So here's the solution.
Wow.
Our tax deferral and asset protection trust, we call it Family Holdings Trust. That is the asset protection. That doesn't get rid of the taxes. The taxes is the private family foundation. So the first things to know, this trust is a non-grantor, irrevocable, complex, discretionary spendthrift trust. It is not self-settled. It is a dynasty trust. So a dynasty trust is you own it, you live within the trust. When you pass away, now your children own it. They live within the trust. They have all your assets. They just took over. So when you die, nobody knows that you died because the title of your property is in the trust. All that happened was now your child is the trustee. So this is generational. Grandchildren get it. Their children get it. It just keeps going, dynasty. So these trusts offer the best asset protection in the United States without going offshore. So again, we call this the Family Holdings Trust. It's a non-grantor trust. Plus, we have a business trust for all of you business owners that want to eliminate tax on your business income tax. So the trust is a contract between the grantor and the trustee. The grantor creates the trust. So the grantor is somebody that is not you that applies for the EIN number. And we can cover that each case, who that grantor should be. The trustee is you, who will manage, invest, and maintain the assets owned by the trust for the ultimate benefit of your beneficiaries. The trust protector, whose main job is protecting the interest of the beneficiary. So we'll go through those roles. So the trust protector's role is to act in a way that's comparable to a board of directors, a public company. You are, most of the time, you are the trust protector. So it is the ultimate authority with respect to the operation of the trust after the grantor's tasks have been completed. And our clients are almost always named as the trust protector to ensure that ultimately you have complete and total control of the trust assets and the decisions made with respect to the trustees and beneficiaries. The role of the trust protector is to add and remove beneficiaries at any time, remove a trustee or appoint a new co-trustee, name or replace successor trustees and successor trust protectors, and you can modify the whole trust document if you want to. So the first step is to get the trust created. So an independent third-party grantor. So start thinking about a family friend, a business associate. It can be a relative, but not a relative that will actively participate in your estate if you passed away. So that person will actually apply for the EIN number with the IRS. And if you're not able to name somebody, we can assign somebody to you. So the grantor of your trust can be any competent adult who will not ever be a trustee or a beneficiary of your trust. So the grantor applies for the EIN number, has the attorneys get the trust documents started, writes a check to the trust checking account to initially fund the trust. And then once that all happens, the grantor will sign their part of the trust that says they're removing themselves irrevocably from the trust. So they can never come back. That's the part that's irrevocable. Everybody goes, oh, an irrevocable trust? I don't want to do that because I want to change things. This trust is the only irrevocable part is the person who applied for the EIN number to get the trust document set up can never come back into the trust when you have all your assets in it and you're living within that trust. So that's the only irrevocable part. The grantor cannot exercise control over the trust assets, and they cannot demand the $50 that they use to fund the trust. Okay, so they're gone forever. They can never come back in. They will never, even in an instant, in any time which your family's assets are in the trust, they will never have control of your trust. None of your family's assets will be transferred to the trust until every right and power from the grantor is permanently forfeited. And remember, they can't even get their $50 back. So now after all that's happened, it's time for you to put your assets into the trust. So you're not going to gift an asset to the trust. You are going to sell your assets to the trust, because if you gift an asset to the trust, now you turned the non-grantor status into a grantor status, and you're defeating the purpose of this trust. So instead of gifting the assets, you're going to sell your assets at fair market value to your trust using a demand note. The demand note is a legal obligation of the trust. There will be interest applied according to the applicable federal rate, and payments are only made on demand of the holder. So you as the holder would make demand on the non-grantor trust when you wanted money pulled out of that trust. So the demand note is non-transferable, so it cannot be reached by a creditor. So after all that's happening, now we want you to live day to day from your trust checking account. So when you spend money, either with a debit card or you're writing a check, you sign your name and put, comma, trustee. Okay. You pay for everything out of that trust checking account that you do now in your regular personal account, and keep receipts. You have to look at this trust as a business for you. You have to keep your receipts so the trust knows what they can write off and what they cannot. This works just as you as an individual. If you could write it off as an individual, you can write it off within the trust. Okay. So if you keep your records in Excel worksheets, QuickBook, similar files, keep doing that. If you're not sure how to do it, we can help with that. But if you're currently keeping your records in a shoebox, you're going to have to start tracking your expenses so we know what we can write off and what we cannot. So this is, I'm sure all of you are business owners and you know how to do that for your business. So now you just have another business going so you can get the tax benefits. Your CPA, enrolled agent, or bookkeeper will prepare the trust's tax return and make sure all of your financial statements are updated at least annually. So now you're living within the trust. You as the trustee.
Hey, Ruth.
Uh-huh.
Quick question on that. If you own multiple companies, like, so we obviously have our primary company that we own, Provision, and then some other companies. And then obviously we have our household budget, right? Yep. So are you saying that all of it goes within the same thing, or
all of it, but the business. When you have an active business, we want to set up a business trust that works right on side of this. So if you have a business, you have all your businesses. And with me, I have 2 businesses, actually 3, but I don't want to change the name of the business to my business trust name. You know what I mean? So I want to keep Financial Tax Strategies, National 1031, because that's branded. So the business trust manages your business. Okay, there's a management agreement. So your business trust manages your businesses. So all your income that you're not using flows to your business trust. The only beneficiary of your business trust is your family holdings trust. Then your family holdings trust can make a donation to your private foundation, which I'm going to talk about, and that's how you eliminate your tax bill.
Okay, perfect. And that makes sense. So yeah. Further question on that is, you said on the original trust, anything that you can write off as an individual, you write off under that. Now under the business trust,
anything you write off as a business? Because
obviously our business. Okay. Yeah, because I was like, we write off a lot as a business because I can.
Right. And you're still going to do that under your business and your business trust, and your personal is your family holdings trust and your personal. So you do your write-offs according to each one, just like you do today. None of that changes.
Keep it. Yeah. Because we keep them very separate. Now, the other question is, if you own 10 businesses and you own real estate and you own, real estate investment, REITs or investments and blah, 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 right? You're everywhere. You got gold and silver. Can you put it all within the same trust? I mean, you may have one for business and one for personal, but do you need a trust per business?
No. One trust for everything. So you put all of your assets, anything that if you got sued today, what would you not want to lose? So that would be any real estate investments, your gold, everything, right? You want to put it all into your trust to protect it. You could have a personal checking account if you want to, but I would keep very little money in your personal checking account, because if someone sued you, then they could take that money from you. But if your cash is in your trust checking account, nobody can touch it.
And then what about businesses that you've had for years? We were recently looking at some trust work, and there's some states that are more favorable, to identity protection and creditor protection and stuff like that. And I was talking to them and I was like, hey, I've had this business for 12 years now. Can I put that into, now that was LLCs, it wasn't trust, but And they were like, no, it needs to stay in Texas and it needs to stay how it is. And I was like, well, poop.
Wrong, wrong. You could put everything into these trusts.
Yeah. Okay. So yeah, and that wasn't trust. That was completely that's LLCs and stuff like that. But yeah, this is cool.
This is the ultimate product that I believe is out there. Okay. So you can buy and sell assets owned by the trust. You can borrow money in the name of the trust, securing the assets that are held by the trust. You can lease vehicles and or equipment. You can lease property to tenants of trust-owned assets. You can buy and sell cryptocurrencies, interest in syndications, exchange traded funds, whatever you want to do. And virtually anything you do as an individual, you now want to do it within your trust. Okay. You can also use optional intellectual property, which is copyrights, trademarks, software you've developed, manuals, all of that you can sell to your trust. And you do that because if you want to pull more money out of your trust tax-free, then you have that intellectual property that you sold. So we would, if you have any of that, then we want to connect you with the attorneys and they'll give you values and that type of thing. And you can even receive distributions from a separate business trust. If you're an owner of a business, you can own an unlimited number of businesses connected to this business trust, and then you don't have to pay the state annual fees for the LLCs. California's $800. I think Wyoming's $59, but you wouldn't have to pay those fees anymore, and you don't have to worry about minutes and all that. Okay, so you can also enter into transactions in the name of the trust to get long-term, even permanent deferral or elimination of capital gains taxes. You can sell your companies, your real estate, any appreciated assets, airplanes, boats, any of that you want to do. And you sell it on a 30-year or a 40-year installment contract, interest only, so you don't pay any capital gains taxes. And I'm going to walk you through the end exactly how that works. So let me finish this part and then I'll walk you through this part. So this is the private family foundation. So you have the trust for the asset protection. Now you need the foundation to give you tax mitigation. So in the case of this trust, it earns income. The trust can deduct the full amount of income it gives away for charitable purposes from its taxable income. This means it won't have to pay taxes on the money it donates to charities. Also, if the trust makes a charitable donation after the end of the taxable year, so let's say 23, after 2023, but before the last day of 2024, it can choose to count that donation as if it was made in 2023. This way, it can still get deduction for that donation made the earlier year. So if you want to zero out your tax return, let's say you have $100,000 of adjusted gross income after all the income comes in, all the legitimate expenses go out. Let's make it simple, $100,000 a year of income. You could take that $100,000, donate it to your private family foundation, and you took your tax bill to zero. Okay. So if an individual, an LLC, or a corporation gives money to a charity, they can only deduct 20 to 60% of that deduction. If the non-grantor trust makes the donation, then they can deduct it in full. So if you put in $100, you get to write off $100, and it's unlimited. Okay, so you can, it's not up to 60% of your adjusted gross income. You can give a charity $1 million and get $1 million write-off. So also, you can even claim this deduction if the charity is located outside of the United States. And it doesn't matter where the charity is based, they can still get the tax deduction if it meets the qualifying criteria. So typically, the qualifying criteria out of state, it needs to be a true 501c3. But let's say that you have a neighbor in your neighborhood, the house burns down and the family needs coats and jackets and water. So if you go get your debit card from your foundation, checking account and go buy the water and the coats and the blankets that the family needs, you can give it to them, and that counts towards your deductions with your private family foundation. Also, the rules, so if you put $100,000 into the private family foundation because you want to wipe out your tax bill to zero, the rules to the foundations are the foundation has to give 5% of its assets to a true charity. Okay, so Wounded Warriors, Red Cross, your favorite dog shelter, your church, a true charity, 5%. So that's $5,000 out of that $100,000 has to give to true charity. But
So
if
you
you
hear
want,
about these Gates or Clinton or whoever that have these family foundation charities. Did you just hear that the law says it has to be at least 5%? Now, hopefully they're giving more, but the reality is
at least 5.
Wow.
Right. So with the foundation, you've given 5,000 away, you have $95,000 of money left in that account, right? So how do you use that money from your foundation? If you're a real estate investor and you want to buy investment real estate, your foundation can partner with you. So if you need a 30% down payment, the foundation can come in with the cash, the 30% down payment, and you can own the other 70%. So all of the rental income from the property, 30% would go to the foundation, the rest would go to you. If that property sells, 30% of the sale would go to the foundation. So there's a lot of different things you can do with the foundation's money that can benefit you. There are ways that if your foundation has a lot of money in it and you need it to get back into your business, there are ways to accomplish that, but that's a whole different phone call, meeting. All right, so neither the family holdings trust nor the business trust are simple trust, they are complex trust. Therefore, contributions from the taxable income of the family holdings or the business trust to your private family foundation that we set up for you when you get your trust, you also get the private family foundation. They're fully deductible. So again, you don't have to worry about the 20 to 60% of your adjusted gross income. You get 100% benefit from your family holdings trust. And subject to a standard of reasonableness, a grant-making private family foundation, which we have, can legally employ family members as directors or trustees, and subject to the prescribed limits, can invest in non-voting equity holder for a profit business, right? For profit activities. So asset protection isn't about making you suit-proof. Anybody can sue you for any reason. Instead, real asset protection is about giving you, as a trustee, the legal leverage to control when and how much, if you get a lawsuit, that you could settle it. Now, remember I told you earlier, if you're not a beneficiary, you can't get the money. But let's say you bumped into somebody and you feel bad, right? They missed some work, they broke their elbow, and you want to cover their bills because you feel bad. Well, you're not going to provide their living expenses for the rest of their life. You don't feel that bad, but you maybe want to give somebody a little bit of money just to say, hey, I'm really sorry, let me cover this for you. You can actually go to your trust book, write their name in as a beneficiary, write the check to them, and then go back to your trust book and remove them as a beneficiary if you want to. You don't have to. If they're being, rude and idiots, you don't have to do anything. But if you want to do something, there is a way to do that. So the asset protection we claim our trust can provide is rooted in the fact that it's common law trust, such as ours is a contract between the trustor and the grantee. The spendthrift provisions contained in the trust instrument are an essential part of the contract. So sections of the legal codes of the U.S. states that are applicable specifically to non-grantor trusts prevent courts from breaching that contract by requiring the trustee to distribute income or principal to anyone who is not a beneficiary of the trust. Ever heard the saying, you can steal more money with a briefcase than you can a gun? You can protect more money with a briefcase than you can with a gun if your briefcase has the right papers in it. So here's the final pieces of this. This trust needs to be renewed every 20 years. When I go to renew mine, I walk to my trust book and I renew it 20 years. There's no cost involved to renew the trust, nothing to file with the copyright holder of the trust or state or federal government. You don't have to file any annual reports. The trust stays in good standing, nothing, no maintenance in that way. And because you have the trust, you don't have to have LLCs if you don't want to, or corporations anymore. That will save you the fee every year to keep those going. The trust, once you have everything in the trust itself can do a 1031 exchange. It can do a tax deferred cash out or a charitable holdings. It can do TELO or statutory trust. It can do all of the tax mitigation things that you could do now as an individual, opportunity zones, angel or other venture capital investments in section 1202 small business stock, and
What
even
about
tax planning tools.
audit? What about audit defense or depreciation? And also Rick was let me start over. Rick is asking about audit defense and also depreciation and recapture of the sale.
This will either eliminate or defer the depreciation from the sale. All of our strategies that we have defer or eliminate the depreciation recapture tax. All right, so this is the ultimate way if you own a business or real estate or an airplane or anything that you're going to sell 2 years from now. If you know that you're going to sell 2 years from now, you need to get this trust set up today. So you take that asset, let's say it's a house, and you sell it to your non-grantor trust at today's fair market value, interest only on 30 to 40-year installment contract. So now from the day you own the property to 2023, all that gain is locked up in that installment contract. Okay. So then after 2 years and a day, so the installment contract is where the non-grantor trust owes you. Okay. Because you carried the paper, you're the bank for your non-grantor trust. So after 2 years and a day, it's required that the non-grantor trust hold the property 2 years and a day before it sells. So now you can sell to any independent third-party buyer. So let's say that you sold the property to the non-grantor trust for $1 million. Now it's 2025, 2 years later, and the property is worth $1,200,000. Okay, so the non-grantor trust sells it to a buyer for $1,200,000. So that becomes a taxable gain to the non-grantor trust for $200,000, because from the time it bought it in 2023 to 2025, it only went up 200,000, and that's the gain for the non-grantor trust. So all the gain from the day you own the property to 2023 are still locked up in that 30-year deferral. The non-grantor trust has to pay tax on 200,000. So what you do is you take the 200,000 gain. If you want to pay no taxes on it, you put it in your private family foundation and you eliminated the tax bill. So you deferred 30 or 40 years from the day you bought the property to 2023, and you eliminated the tax bill from 2023 to 2025 because you put it in the foundation. Okay, hope that makes sense to everybody. So if you wanted to get started, we would send you a recorded presentation on this and a summary of how this works. Then you would set up a time with financial education for us to walk through your situation. We would take an intake form, apply for the EIN number, and start talking to you about the best way to make this happen for you. If you don't want to wait 2 years and a day to sell something, we have tax deferred cash out strategy, and we have charitable holdings company that can eliminate 99% of your tax bill. So here is my contact information, and I'm ready to answer any questions you guys have.
All right. Any further Q&A? I see Rick says that you are now his best friend and hero.
Awesome.
Is there a way to make everyone where they can just speak up?
In a
Not on a
webinar
webinar like
format,
this.
I don't think so.
Okay.
Any other questions from people? I know we've covered a lot today. So yeah, no more LLCs. You can literally put it all within your trust. Ruth, again, if your CPA comes to you and says you owe $35,000 this quarter or this year or whatever it is, right? Walk me through what we do here if we own this trust and they say you need to pay 35 grand.
So if your adjusted gross income is 100,000, which makes you owe 35,000, then you want to put the 100,000 into your foundation and you can make your tax bill 0. So let's say you want to eliminate half of it. And you're okay, I'm willing to give the IRS 15,000, but not 30. So put 50,000 in your foundation, and then you're going to cut your tax bill in half. So at the end of every year, I get to choose, how much do I want to give to the IRS and how much do I want to give to my foundation? So you don't really want to take your tax bill to 0 if you plan on buying real estate or you need to grow your business and you need funding. So you have to take that into consideration. How much do I need to show on my income tax to meet my goals of, financing and that? But if you're at the end and you're like, I'm not building anything, I'm not financing anything, I'm not buying any more houses, 0 IRS, I'm done with you guys. I'm giving no more to you. You can do it legally.
Yeah, or if you're a former president and everybody knows that you're a billionaire, you can make yourself not owe any taxes and you can still keep buying properties with other people's money. But yeah, if you still need to show income in order to get money from banks and investors, yeah, you don't want to give yourself 0. Otherwise, it's a wild concept, but this is literally what billionaires and politicians and them, this is what they're doing. Like, this is how they're doing it. You see the exact strategies that they're doing in this.
Steve wanted to know, how do you sell a reverse mortgaged home to the trust?
That might be difficult with a reverse mortgage on it because you're actually selling the property to the trust. But in a lot of states, you can sell a property to the trust, prepare the deed, and never record it. So I would think that would probably be the best way to do a reverse mortgage property, is just to sell it to the trust for the asset protection. Don't record it so the reverse mortgage company won't get upset about it, and you can still have your legitimate asset protection. I would just need to know, as long as you're not in South Carolina, you're pretty safe.
Oh, and that's another question that comes up is this, because a lot of trusts are specific to certain states, right? Or they're excluded from certain states. Does this trust work in all 50 or?
It works. We use South Dakota for the trust laws because they have the best trust laws. So South Dakota is where the trust comes from. And then of course it references from where you're at also. But South Dakota is what we're using for this trust.
Rick says, I have an
Perfect.
installment sale going on with a balloon in 3 years, paying taxes on interest now on the note. So just move the note into the trust?
You can sell the note to the trust, yes.
Sell the note.
So it's kind of like a wraparound note, if you guys are familiar with wraparounds. People used to sell their homes on a wraparound mortgage, and then the client made the payment to you, and then you made the payment to the lender. So that's kind of like a wraparound thing.
Yeah.
Perfect. Any other questions? I know we're at time, so I don't want to keep anybody extra, but obviously this isn't something we see every day, but it is real. It does work. And now, Ruth, we never addressed this, right? So the question I asked at the very beginning, what separates you, and maybe you did and I just missed it because I'm looking at the baseball stadium behind me. But what separates you from everybody else that's talking about, trust and stuff like that? Now, as far as audits,
everything I do has been vetted by multiple CPAs and tax attorneys. We are members of the Due Diligence Project. The Due Diligence Project is about 800 CPAs and tax professionals. It's a group, and you do have to pay a fee to get in, but you have to be qualified. You have to show that you have more than 10,000 hours of tax planning, not just tax preparation, filling out tax returns, but you have to be vetted to become part of this group. So we belong to that. And not only do we run everything through them, but we run it through several attorneys. I've been in this business for 30 years. I have a lot of attorney friends that have actually become my friends because I rely on them to, when I find out these products, I say, okay, does it work? And I wait until I get everybody telling me, yes, it works, it's good to go. So this one is definitely I's dotted, T's crossed, ironclad asset protection. Oh, and I know why you said, I've been audited by the IRS. I do a lot of different strategies, and one of them I was audited, and the IRS told me to come and give them 6 hours of my time. I'm like, oh man, what are they going to talk about for 6 hours? I was done in an hour, and I had IRS counsel, two auditors, one taking notes and one that was my auditor. And by the time that they were done with me and I explained why I talk about the strategies, and it wasn't this one, it was one different one. And they said, are you going to continue talking about this? And I said, yes. And they said, okay. That was 2 years ago. So, the IRS does know me, and they know I have these trusts. And I'm like, come on, IRS. I can't wait for you to audit me on this one. For me personally, I didn't get audited personally for the other strategy, but audit me personally. And I can't wait to say, I find, I'm not worried about them. And so this is why I feel very good about this. Yes, I was involved with talking about the other one, but I never felt good about the trust they use 643. This uses 642, IRS Code Section 642. And I have never met an attorney or a CPA that says, yeah, this doesn't work. They're like, oh no, this is it. This is the answer.
Well, awesome. Catherine, did you have any other questions?
No, but I did just Google IRS code 642, so I'm gonna nerd up on that.
Catherine, I can send you all the great things on 642.
I'm excited to learn. So yeah.
I'll email that to you. Anybody that wants it, I'll email it to you. We have, we work with a lot of different attorneys. We want an attorney in every state to represent this trust. And so a lot of times attorneys say, I'm interested, and I send them, overwhelming amount of information. So when I have people that go, I want all of it, not a problem. I've got all of it.
I'll take all of it.
All right. Sounds good.
With some
Yes.
reason. But yeah. Thank
Perfect.
you.
Well, Ruth, thank you so much for joining us today, and for everybody else for joining us and your questions. And I mean, I'm sure there's a million more questions. We are going to have this as a recording that you can watch and you can share. But let us know how we can help. And Ruth, give our love to John. And we are so grateful for you and your friendship and your amazing tax ninja strategies.
I love that, tax ninja. All right. Thank you.
Thank you. Bye.